But welcome to this hopefully very fun, spontaneous, and real panel where amazing people from different parts of the world, Eduardo from New York, Juan in Madrid, and Ichazo, normally in London, but now in Barcelona, will share the ups and downs, the reality, the behind the scenes of everything that has happened in the last few months, or I would say even years, in tech. We hope that at the end of the session or during the session, you guys can come with any questions, any ideas, any tough and difficult questions. One thing that as a crew here we want is to make sure that all the tough questions that you wanted to make to somebody in the investment world, you can make them today. So as you know, we just launched our Q3 benchmark report. For us, it was very important from in the last 2 years, not only to show what has happened in the big numbers all over the world, but also what's happening in the regions where we are investing and where you guys are building. So the comparison of what's going on in Latin America, in the US and Europe has never been as interesting. We are coming from years of from the golden years to a years of very much kind of like under bubbly years in some way, but also years of very interesting product creation and years of a lot of new investors entering the space. So for that reason, you will find that, and I guess that Alessia is pasting the BC benchmark report in the chat so that you guys can look at it and any questions or any beams that you want to hear, not from just Eduardo, Juan, and Ichazo, but from many others that contributed. You can guys listen to them carefully and if possible, learn something new. So without further ado, I'm going to introduce and I'm going to let these amazing team of people introduce themselves. Ichazo, please tell us about you, about your experience, and about any key message that you want to give to start the audience here today.
Hi, thank you, Laura. It's great to be with you here in this global panel. I love it. So I'm Ichazo. I'm a partner at a venture capital firm called Notion. Notion Capital has nothing to do with a note-taking app called Notion too, but we are instead an investor. We've been investing, in fact, for 13 years. They just have taken our brand big time, but we've been investing in SaaS, B2B SaaS companies for 13 years now, based in London. The whole team is based in London. We are a pretty international team with 10, 12 nationalities within the team and covering investment across Europe. Obviously, our investments are in Series A, and as soon as we invest, the companies are already growing globally, either to the US or to Latin America mainly, not that we don't see that much to Asia, as we can as a team help them as much as we would like to. We like to be very close to the companies. We have 8 people in the team who are experts on SaaS and help our companies with the SaaS go-to-market. And I think today more than ever, companies definitely need to get faster on everything they do and do it efficiently with less capital. And we will talk a little bit more about that today. But that's in a nutshell. That's it. Prior to Notion, I was running Microsoft Ventures in Europe, so which is the investment arm of Microsoft. So also doing SaaS, cloud, AI, and yeah, that's a little bit of my my background. I'm Spanish, if you didn't figure that out from my accent yet, even though I've been in London for 12 years. I get this accent with me everywhere.
So what you guys don't know about Ichazo is that she is an expert in product-led growth. There's an amazing, she writes a lot about it in very many media. So it's if you want an investor that knows the hard things, she knows. So for everybody attending, this is Chazo.
Yeah,
Super
we can talk
Juan.
about it later too.
Yes, we should talk about it later as well. Super Juan, amazing founder with a wonderful career in many ways. Juan, would you introduce yourself?
Sure. Yeah. I like to say that I'm an engineer, a data guy, and a finance guy at the same time. I worked as a banker, private equity investor, and then I spent 8 years being the CFO of Cabify. And then in 2020, a couple of years ago, I founded Bupos. We operate an M&A financing platform, an acquisition financing platform. So what we essentially do is empower people who are looking to become their own bosses by acquiring a small business typically anywhere between 200K to 2 million US dollars in terms of sales and acquisition price. So we help them achieve that type of objective by lending on them, which is something that big banks won't do because they don't have the underwriting capabilities to help these people acquire the businesses. Everything is facilitated through an online platform. You can also scout for pre-approved opportunities, which is also very useful for these people who are looking to buy a business, but they don't know exactly what type of business they're after. And we partner with all these brokers that are listing companies in the website, so we can pre-approve them and help them close the transactions. Um,
So one thing that Juan is not saying is that he raised an amazing round a couple months ago or 3 months ago. Juan, when did you raise? How much did you raise?
Yeah, we raised 7.5 million in equity and then 50 million in debt so that we can, assist our clients with financing.
Yeah, so in the middle of when everything looks very dark and stuff, big products always, good products always win. And Juan is a testament of that. Also, for those that are joining from different parts of the world, Cabify is one of the first unicorns in Europe. And Juan has been, there from the very beginning. So he has also contributed to the growth of a fantastic company. So looking forward to chat more with you, Juan. Now,
Definitely.
Super Eduardo, based in New York. Eduardo, amazing background. What would you want to share with the audience?
It's too long of a story to share in full, but I guess I did the opposite path to Juan. Engineer too. Started two businesses with my brother, one that he still runs today, based in Spain, and now internationalizing to Portugal, Italy, France, Belgium. A personal situation, family situation, made me start working with my father in his small company in the infrastructure Spain, in the infrastructure market in Spain. I'm also a Spaniard, as my accent tells. And then after that was exited and my brother was full steam ahead with the business, I wanted a change. I was always, very keen into American pop culture and loved finance and the investing world. So sat down with my mom, and probably the only one time I followed her advice. She would say, go to the US. I said, why not? So moved here in 2014, worked in Merrill Lynch in the M&A team here in the US, and now been the last 5 years at LionTree. LionTree is a merchant bank. We have offices in New York, San Francisco, London, and Paris. We do technology, media, and telecom. Obviously, over time, the telecom is fading away towards media and now towards tech. Merchant bank, for the ones that are not familiar with the term, is basically how investment banking and private equity started, when before the regulation, financial firms could both advise and invest in the deals they were advising. So we manage multi-billion pool of capital from institutional investors across different strategies, VC, growth, co-investments in private equity controlled buyouts. And then we obviously have a very well-known advisory franchise in large cap M&A and growth cap M&A. Maybe for some of the folks on the line, if they are familiar with the European growth market, we just did the SITAC Advent deal in Spain this summer, talking about tough times and good outcomes.
Fantastic. Thank you, Edu. Also, Edu is an amazing mentor for many of us, I have to say, and many of the founders. He is always available to support anyone. Of course, he does very, very big things and very, very big deals. But it's also, it's amazing to be able to count on him. He's also part of the VC benchmark report this time. Okay, so let's get into the, now that you know everybody here, I hope that you guys know the Venture City. I'm not going to take time explaining what we do. So just, maybe go to our website or just read through the VC benchmark report and you will see how we're made up. We're investors as well. But just so that we can get into the details. We're facing something unprecedented in many ways. Well, many of us went through the dot-com bubble in the early 2000s, but this is different in many ways. So before we wanted to start as investors ourselves and investors and founders in different stages, we wanted to put a little bit of optimism as we start. And Edu was graciously showing us a couple of slides that I don't know if you can share right now. Can you share?
Yeah, happy to.
Yes. So a couple of slides that basically set the tone of what we're going to be discussing today. So Edu, yours.
Yeah. So this we put together in the first month of COVID. A colleague of mine here who's great. Kudos to him. Basically, it's like, look, history doesn't repeat, but rhymes. We have this saying in Spain, like muddy waters, fish are game. Whatever the translation to English is, but in crisis there is opportunity, right? So if you look at history, this is a Kaufman Foundation study, so one of the most reputed venture capital foundations and institutions in the world, and it comes to show. I'll skip through it in 30 seconds, and then I'll send it to Laura and her team so she can distribute broadly. But basically, you go through every single most important crisis of the last century plus, and you will see that industry behemoths were founded during those times. So you have in the 1890s, you have GE coming to life. Later on, GM. Then you have IBM. You have Walt Disney in the middle of the Great Depression. You have Hewlett Packard. You have Burger King, Hyatt, Trader Joe's, all companies that would resonate with most of the people. And you see, as technology becomes more pervasive and it becomes an industry that touches every other industry, you start to see also technology companies showing up here, or technology companies that we are familiar with now, like Microsoft or EA. And then if we go, Laura alluded to it, if you go to the dot-com bubble, you have the Google, the Salesforce, Everbridge. And then in the middle of the 2008 crisis, you have Uber, and you have Square, and Slack, and Zalando, Airbnb. So, oops, my bag just fell. So it's not only that good companies attract capital. It's not only that good companies survive. It's also that good companies, good founders, good products thrive in crisis because they take market share, they take disproportionate attention from the investor world, and they take disproportionate customer attention and love. So I would say, look, the situation is not, I'll stop here. As I said, I'll share it broadly through the Venture City team. It's not only that, and hopefully the few slides prove it, it's not only that you can survive, you can do well in a crisis, it's also that you can become the next big thing, because on a relative basis, right, you are multiples more appealing or compelling than other options are. Also, as macroeconomic cycle tightens, right, the barriers to entry the investing world go up, right? Capital is more scarce, capital is more expensive, so investor quality also goes up. Hence, lower quality investment opportunities are less followed, and people with the need to overpay to build a portfolio slowly fade away. So anyway, I would be, as an entrepreneur, without getting too technical before we have, I would look at this as a great opportunity, right? Obviously, like, it's not the ideal world. It's not an easy world. Things take more TLC now, more tender loving care to get done. But I think the quality and good businesses and good visions continue to get funded, continue to win market share, and in a market like this, disproportionately so. So anyway,
in fact, building on that, Eduardo, you guys are investing. Ichazo, you guys are investing right now. Juan, you just raise around,
Yes.
and we are investing. We have invested in 7 companies this year, so there is capital available for those that are building amazing things. It's just so sorry that I cut you off.
No, I was just going to say that I love that Eduardo is bringing COVID back to us, because it really felt at the beginning of COVID that like a big market crisis was going to happen, when markets like travel, like recruitment, like some of those markets were hospitality were completely down, and we thought, hey, hold on a second, what are we going to do? And we have companies in the portfolio who are Muse in our portfolio, for example, is selling to hotels. They run basically the full booking system of the hotels, everything, like competing with Oracle, which looks like a big competitor, but pretty clunky product, as you can imagine. But when hotels are closed, then there is very little you can sell, right? And it's still, I think COVID really helped them to become much more efficient. And I think I do like to think today, I think everyone is talking about extend your runway. I think I like to think about it much more in terms of build efficiencies and think of an efficient way to grow. Because in reality, if you are very bullish about your market, you know exactly who your ideal customer profile is, and you can efficiently reach out to that customer. There is no need for you to be slowing down and pushing back. You should reach out to that customer. The problem comes when there is no product market fit and we don't know that ideal customer profile. And then we are shooting 5 times before we hit once. And then we are wasting 4 of those bullets. Now is not the time to do it. Now is not the time to experiment that way. But I think those efficiencies were also built at the time. And I think companies have gotten out much stronger. This company I just mentioned, Muse, right now, I mean, just went over 100 million in revenue, which is much higher revenue than when they were before COVID, right? And I think all those things are very, very important. And it still makes companies stronger.
Yeah, and Juan, so when you were fundraising this year with you're a very early stage company, and you were saying that the whole world was kind of like collapsing. The news couldn't be more terrifying. Everything was. So what did you do with your team? Did you guys focus on what you do best? Did you guys kind of like isolated the noise and just pay attention to the music? What was your situation there?
I mean, we were at a point where we needed to fundraise, right? Because we were scaling pretty fast. We had clear product market fit, and basically for scaling, we needed additional funding. So there's no way I could just shelf that off until 2023 or try to extend my runway, cut costs. That wasn't an option for me because the opportunity was massive, and I just couldn't stop that. So what did we do? I mean, we just kept on doing what we did, which was doing pretty well, but we obviously adapted to the new environment. So I'll give you an example. We're doing M&A financing, which means that we fund like up to 80% of a small acquisition. So back in 2021, that would mean lending maybe 3 to 4 times profit, because these acquisitions are priced at around 5 times. So in the new context, multiples are more like 3, maybe 2.5 times. So that means that we would change our strategy and lend lower amounts that would still be useful for acquiring businesses. And at the same time, we would lower our risk, right? So in the end, I would say that the equation between risk and return improves because of this crisis situation in our case. And that's, I guess that's only one of the factors, right? The other one is that we're very lean in managing the whole company. We're, I would say, a low-cost type of structure. And with those things in place and good traction, good growth, we were able to fundraise. I tell you, it wasn't easy. It was we had to talk to a lot of people. Many of them were completely out of the market, but we learned that there was still money out there, and actually there still is. We have like 3 term sheets on our table right now for additional debt, so that we keep on growing. It's just that you have to be more efficient, more opportunistic, adapt to the market conditions. That's the type of things that you have to do.
Yeah, you know, and these one of the learnings of the benchmark report was that there is a lot of capital out there. It is now kind of like holding off because people want to, or investors are trying to understand, okay, how far is this going to go? We're not deploying capital as fast as we used to be, etc. But the capital is there, and I think that when we meet founders that we can fall in love with their product, their teams, their traction, and their vision, we put the money there. So one of the conclusions is that already in Q3, capital was kind of like slowing down, and as we see in every market, US, Latam, Europe, in every stage, everything is it's not only slowing down, but also there are less deals happening, right? So what is your take there, guys? Edu, tell us a little bit about how you see the situation right now with all these factors interfering. There's a ton of capital. Where is all that capital going to be deployed in all these founders?
Yeah. I guess I'll respond the question indirectly. The reality is that in a context of essentially free cost of capital, right? Like zero cost of capital. And by the way, if you look at the real rates, so nominal rates less inflation, right? We are still in negative rate environment, negative real rates, right? So, but anyway, if you look at the last 3 years, like there was an incredible amount of capital, risk assets, meaning venture, high growth debt, public or not, became one of the only options to extract yield and return for everyone out there sitting on all these pools of capital. And as I said before, there were less barriers to entry to invest in these assets, right? In the venture world, we also saw the proliferation of new venture funds, capital raising was non-stoppable. And I think many stopped asking, and Ichazo alluded to it before, like capital efficiency is key, right? And you can look at capital efficiency many ways: return on invested capital, capital consumption ratio, burn multiples. There are many frameworks to look at capital efficiency, and that was almost never part of the equation for many non-quality stories, both on the investor side and on the investees side. But if you take it even backwards, like you saw, because the access to capital was, let's say, easier than historically, right? You saw many new opportunities coming to market without necessarily having answered critical and foundational questions to themselves and their businesses, like product market fit, right? Go-to-market strategy, has that been validated? Are my economics durable and scalable? So all those questions now are paramount. So my point, and this is my Spanish way to answer a question in very long terms, is now the capital is going to capital efficient stories that have a check on product market fit, a check on go-to-market strategy, and that has been validated or in process to be validated, and that have direct visibility or already proven scalable and durable unit economics. Right? We saw, for example, it was pre-COVID, but I alluded to it because I genuinely enjoy it with my background micromobility, right? Like in the scooter companies and the amount of capital that went to this sector. It's a sound sector. It definitely fits both a social, right, and economic need, right? But depreciation doesn't scale. Doesn't matter if you have 1,000 scooters or 10 million scooters. Depreciation doesn't scale. And no one was asking that question. Why? Because there was enough capital behind to approach it as a land grab, and then we'll figure out the capital efficiency question later on. The problem is that it's very difficult to figure out capital efficiency in that market, and now we are seeing consolidation. Some of these companies are struggling. So I guess, Laura, my view is high quality, capital efficient companies now, or that have proven those other three aspects in their roadmap to prove capital efficient scale.
Yeah, you know, I remember back in 1999, 2000, I had this company with other co-founders. It was about tourism and beaches, and we had an amazing product. We had video on the internet when there was no video but porn, and our beaches. You know, we were recording beaches all over the Spanish and the Portuguese geography, which was very advanced. YouTube was born in 2004, and we were already there on the internet in 1999. So we had the product, we had the traction, you know, and I remember that because it was so nascent, the internet and everything. You know, you can't imagine the amount of doors that closed just because of the .com thing. You know, they wouldn't look into anything. This is why I was saying before, this is different now. Everybody loves to see how technology is going to be changing our lives. We are meeting more founders than ever in many ways. But you know, to all those founders listening to us, and I guess that also those co-investors and friends from the investment world, companies that are well built will always be the companies where we want to invest. In the last year and a half, I saw tons of companies, and you know, but there was no product market fit, or there was no clear monetization viability. There was nothing there as to say. And we invest in seed stage. We love seed and pre-seed. So the message out there is good companies, good vision, good teams. Everybody's interested on them. Those crazy valuations of 20, 30, 50 times nothing are not going to happen anymore. I don't think it was good for the founders last year or the year before, and I don't think it's going to be good in the future. I think that we all, when we are deciding about our cap table and the businesses where we want to invest, you want people down to earth, really looking into the product, in the engineering, into the data, and not really like building castles on air. So I think this is something that is going to be instrumental in the next few months. Good. So
I would
yeah,
add, Laura, very quickly there, without monopolizing the panel, that those companies that raise tons of capital, right, Series A through D, whatever, right, and at very high valuations, most of that capital comes with structure, meaning liquidation preferences, anti-dilution provisions. And in an ever-growing valuations environment, that never comes to play, because there is always a next bigger, better round, a listing, SPAC. There are always options. Now in a higher cost of capital environment where a scarcity value of capital may become a thing again because capital stopped being scarce, those liquidation preferences matter, because, you know, like governance wise, you need the latest class to approve any transaction mostly. So a down round may become a problem to get approved. An M&A transaction at a sound value for every investor, but the latest one, or for the entrepreneurs with a strategic, may be difficult. So I think we're going to see a very interesting environment on private M&A work.
yes, that's a good point. Ichazo, are you seeing, because we are also seeing that, are you seeing, I think that 2021 was the year of the mega rounds, and 2023 is going to be the year of the mega acquisitions, of the mega M&A. Are you seeing anything crazy on your side in that regard in your companies?
So definitely we've seen a pretty active M&A environment, and specifically companies, surprisingly, those, so on the portfolio, on a portfolio construction, always a VC has those top tier businesses, right, that are growing very fast, high valuations. And then we have these middle tier companies closer to the top tier, still growing, but maybe not that fast growth that easily can in fact become profitable. And those businesses are being targeted and poached by other bigger unicorns or corporations trying to acquire also revenue and healthy businesses. So for investors and for some founders, it has been a good opportunity. If you have been building a business and you have thought properly and you are thinking properly, even though you are not growing at 3x year on year, if you are having a growth which is still attractive and still okay and still efficient, as we talked about earlier, I think there is a massive opportunity for those businesses to be acquired and to become part of a bigger organization and have the opportunity to build still your businesses there. I think there is a lot of activity happening on those, but again, efficiency is on the core of all of those. So I think that is something that we need to keep thinking of, right, as founders.
And Juan, you're right there. You're reinventing M&A. So what are you seeing?
Oh, we're seeing a lot of people. I mean, I'm on the small M&A segment rather than the mega M&A, but we're seeing a lot of people actually getting interested in the space, because in the end, actually, it's interesting because it's related to the high valuations that we were talking before. You see all these people whose stock options are probably worthless now because of this big liquidation preference, because maybe companies raised more money than they needed. And they're kind of a little bit skeptical of stock options. And we're seeing that when we're hiring people. And many of these people are kind of redirecting their lives toward, I would say, an alternative type of lifestyle, right? Like buying a business, like owning a business, like maybe starting a business themselves and being the founders, etc. So I guess that, you know, that takes me to the fact that the current fundraising environment is probably much healthier than the one that we had 1 year ago, where you would raise an infinite amount of money that you potentially won't need. You have huge liquidation preferences that pose a risk to the motivation of your team. I think that it's good to have healthy valuations, to make sure that those valuations grow over time, that your team sees how the value of the stock options grow over time. But then, you know, you don't want to risk your team becoming skeptical of their stakes in the company, right?
So, you know, we've talked about what each of you guys do in the different regions, New York, and as a founder based in small M&A in the US, Chaso in Europe. We're based in Latam as well, Europe and the US. And it's clear, and I want to set this message before we move into the next topic. It is clear that there has not been a better moment to build a company than this one, despite the noise. There's a lot of capital. If you're building a good company that has good customers, good traction, this is a good moment still for you. What happened last year, that you would go to the market and people will throw money at you, was not real. That wasn't real. So it is still a good moment. And this is the moment to build the best companies that we are going to see flying in the next 10 years. So with a situation like this, we are every day bombarded with layoffs here and there. I was, in fact, one of the laid off people at eBay back in the financial crisis in 2008. So I know the big time where you're kind of like, what? From one day to the next, you're being laid off. In my situation, you know, I met Mark Zuckerberg right away because he came to Spain. So sometimes doors close in one side and bigger ones open somewhere else. But yes, I was one of the ones that got laid off in 2008 in eBay in Spain. So what would we say to all those people right now that are being laid off all over the world? All those companies that need to lay off. It's the last decision that you want to make as a founder yourself. Decide on sizing down your team when there's extraordinary people behind it, right? So how about this sentiment, these hard decisions, this efficiency that we were talking about? What would you say for those people that need to lay off or that are being laid off? Who wants to go first?
Go first, because I talk to a lot of these people, and I guess that, yeah, they've grown a little skeptical, but I agree with you. There's an opportunity when something changes in your life. There's a big opportunity. So maybe you want to join a smaller company where you can make an impact, because many of the people that are being laid off come from big companies, and their job was not as stimulating as it used to be maybe 5 years ago. Maybe you want to spend more time with your family, which is something that you might have skipped throughout all these years. maybe you want to completely reinvent yourself and join a different industry. So I think there will be opportunities. The good thing is that unemployment is at record lows still, despite all what's going on. So I think that there will be, I would say there will be a cohort of new companies started by people who are being laid off at this time, and we'll see that in probably 5 to 10 years. So I think this is obviously not the end of the world. It's a huge opportunity for many people.
It's the beginning. It's the beginning.
I agree. I absolutely agree with that. And I usually I tend to think that the biggest promotions happen always through jobs and company changes, always. And so everyone who is kind of coming out of a business and it's basically a fast growing business has more experience than when they join, and it is a great opportunity to go to another business, find a much suitable and higher position for them, and probably a promotion, as I said, because biggest promotions come always with company changes, for sure.
I would say on my end, for anyone impacted by this, I try to help. And I think, like not necessarily believe in karma, but like, do good by these people, help them think through what to do next, either if it is an entrepreneurial endeavor or a next corporate challenge or joining a startup, be helpful to others, right? You never know, next time could be you. So that comes first and foremost. And second, if like talking about big tech, following your lead, Laura, like the employee count grew like crazy over the next 3 years as a result of, again, exuberance in the capital markets, low cost of capital, the requirement to have big, bold, strategic bets, right? And now in a context where, right, like before, you needed to invest in high growth tech equities to get 5, 10%, 12, 15% a year, whatever it is, right? Now you can go and buy bonds of some of these companies that are yielding 15% plus, right? So now there is an opportunity cost for investors to allocate to those equities, and to continue to allocate to those equities, investors are demanding these companies to spit out cash, either in the share of operating cash flow or returning to shareholders. So unfortunate as it is, it's part of the economic cycle, and hopefully everyone will find the next challenge.
And so for those that are listening to us now, if you know of a company that is needing to lay off people, or if you've been laid off, in our portfolios, we have a ton of companies hiring, and in the VC kind of like community, we try to help as much as we can, reallocating people fast because of what Itxaso and Juan are saying, like, even though a lot of people is being laid off, the industry is growing more than ever. In fact, one of the things that, that we were seeing industry-wise, and I'm curious to hear from you guys, is if you're seeing a transition from these techs to other industries that feel a little bit less stressed, than tech, like, for example, biotech, alternative energies, and things like that. Are you seeing anything like that? People flying from one industry to another?
To be honest, we are specifically focused on B2B SaaS. And as you all probably know, COVID accelerated the adoption of cloud and SaaS applications and everything related with cloud, basically. And so I do think that trend, we are just touching the surface of that market, at that growth in that respect, right? And so I don't think there is a shortage of opportunities in this space. Personally, I still feel very bullish. And I do think that if we can think of some industries which are more stable, probably SaaS is one of them, in terms of being able to predict revenue, sustainable revenue, recurring revenue, and ultimately, those are the operating systems of the businesses. Businesses need to operate, so they need to have their data, their processes, their applications in place. And so I don't think that can change from one day to another one. So I personally feel I'm in a good space. I'm not sure the other ones on the on the panel, because I'm not that knowledgeable what is happening maybe more maybe consumer businesses, and maybe Eduardo that is seeing much more the market can talk about that, or even Laura in the Venture City. I don't know, you guys, what's your view?
Well, I think we need to bifurcate between general transitions, which I think are sure at the mid and junior levels. There is always the option to switch as you become more specialized and more senior. It's more difficult to transition industries in full, right? You can go from one to another adjacency, but there is transition. In terms of tech talent or technical talent, right? Like the reality is that universities are not delivering enough computer scientists and data specialized professionals relative to the market demand. So it's very common to see technical talent to jump from A to B quite seamlessly. And now obviously, like you saw that, for example, with crypto, right?
Yeah.
Big boom on crypto, massive amount of people, both non-technical and technical, jumping over as some of these models are being challenged, or the industry is being more questioned. Some of these same talent, both technical and non-technical, are migrating back to other tech, other media, other industries. So I think it's true that is changing. I think the question including alternative energy, right? Again, it depends on the profile, because at the managerial level, depends on where you're coming from. At the technical level, is a highly specialized vertical. So like, obviously, if you are working in something relevant, you can make that transition. If you are a guy in a suit like I am, it's probably difficult to go there, be an engineer again.
We will welcome you anywhere, Eduardo. It doesn't matter if you're wearing a suit or whatever. You know what we're seeing, and this is interesting. I think that the biggest industries, pharma, energy, telco, healthcare, all these big industries that have, you know, tons of years and, you know, very stabilized, and those are the ones that are going to be much more disrupted in years to come. I am seeing, in fact, biotech, for example, it's so interesting to see that a lot of the talent in these places, researchers and you know, scientists, is people that are, especially in Europe and Latin America, and not that much in the US. I think in the US universities do a great job at, you know, when you go there, you have, you know, the MIT lab, or you have the Stanford StartX, or you have the Harvard, you know, there's these places where you're not only taught about your profession, but also how to build a business with it. If you're a scientist in retinol, or if you are in microbiome or anything like that, these people are, in the US at least, are much more prepared to the science get closer to the business. In Europe and in Latin America, it's still too far away. It's still too far away. Who is a scientist is a scientist, goes to the scientist path. And it's much more complicated to pair a scientist with a business creator, right? So I think there's an enormous opportunity. And I think that in the next few years, in particular in Europe, because I think Europe is the land of the Nobel Prizes in many ways. I think we're going to see amazing researchers and scientists that are going to be creating companies for the first time, that are going to be tremendously in space tech and in so many other things. Amazing, right? So I think, I'm not sure if I'm seeing the move as much from tech to other disciplines, or within the same discipline, people pairing with people in tech to take the businesses forward. So I think this is the next 5 years, we're going to be very fascinated by that. In fact, one of the questions that we have from the audience is, where do we believe, or which industries do we believe are going to be key in the next 5 years? So who wants to go first?
Scott, I think, back in the day when I was at Cabify, people used to ask us, how big is your market? They were thinking of the taxi market. And I would say, look, we have like 0.5% market share if you think of all the mobility space. And the mobility space is super old and needs to be changed. I was going to say disrupted, but at least changed, right? And it should evolve because it's super old and there's a lot to be done. I'm seeing or having the same feeling at the fintech space right now. You have all these platforms and they investors say, oh, how big can you grow? And how much of a relevant player can you become? You have to think of the big old banks providing financial services and there's a lot to be done there. So I'm pretty sure there's a lot to be changed in the fintech space in the next 5 to 10 years. There will be hiccups, there will be ups and downs as always, but I'm pretty sure that in the long run, financial technology is going to be super, super important in the way the financial world works.
Yeah, I'll build on that, and more than 5 bets, I'll discuss a couple of things I see interesting. Echoing the fintech, I do think that in marketing tech, there are very interesting things happening, right? Is a major driver for many companies across industries, and there is massive budgets at corporate levels being allocated, not necessarily with a technology standard or approach behind it. So I think marketing SaaS will continue to be super active and innovative. I think in consumer land is very interesting. The fact that, and it's related to the former too, before, right? Like people talk about the creator economy. Before you saw consumer products looking for creator/talent attachments. Now we're seeing this reverse trend of the content driving the consumer products, right? The creator builds the content and then they outsource the production, which I think is fascinating. Yeah, those two are very interesting to me, generally speaking, I would say.
Yeah. So in fact, I'm going to take the opportunity to touch into product-led growth now. Which I do think that it is definitely a great opportunity and a trend. And if we think of yesterday, I was here having a dinner and an event, and people were like, what else do we need in SaaS? What is out there that is going to come out and basically, and I do think that nobody thought about having a CRM before Salesforce was there, right? And so there are a lot of new product categories to be invented still, because clearly we don't get to the office and feel that our workflows are completely seamless. If that will be the case, then I will be worried about SaaS. But until that point, I'm still thinking we can build new products. However, I'm a big believer that people today want to try the product before we buy them, right? The same when you go to a shop to buy some shoes and you want to try the shoes, and the lady at the shop is not asking you, so sorry, what's your email address? And you're like, no, I want to try the shoes. And they're like, no, give me your email address and your phone number. You're like, why do I need to give you my email address and my phone number before I try my shoes? I don't understand, right? So that's what we do in software today. Somebody calls you on the phone and asks you all these questions. That makes no sense whatsoever. So I do think that there is still a lot of new product categories to build, to make workflows much more efficient. So in a hybrid working environment, which I think has become much more of a trend, where people are not overlapping at the office as much as they were before. I'm not saying always remote, but definitely hybrid, right? So I think there is a lot to reinvent in that environment, and clearly product-led growth is the way to go forward, and empowering both employees and developers to make their choices on what do they use to within their day-to-day basis is the way to go, I think.
I would add two more that, Laura, you have exposure to. I didn't mention before, and I think are very interesting. I think in logistics land, following Ichazo's comment and Juan's too, I think there is major opportunity. And it's interesting also to look at education tech, right? Because many interesting stories have been developed and gone public, and M&A, private equity is in there. But still, if you look at the time spent relative to money spent, right, is still the time spent is vastly online, regardless of you going to a traditional university or not. It's vastly online, a vast majority of the time. However, a vast majority of the money is spent in not online education channels. So this is similar to the mobile advertising industry emergence, when before it was all desktop, and like very interesting to explore that too.
Okay, so thank you very much, guys. I think that we should need another 45 minutes to discuss even more all the things that we have and all the questions that we couldn't solve for the audience. So we may be thinking about doing another session maybe next week or in a couple of weeks. But thank you for being so direct and honest and for being so optimistic. Thank you, Juan. Keep building what you're building. And thank you for everybody that showed up today. We learn a lot from you guys and from the founders that we work with and from the founders that we will work with. So thank you, everybody, very much. Let's talk soon. Ciao.
Thank you.
Thanks.
Thank you.
Bye. Bye.
Bye.